All right. Welcome to another earnings reviews video, and this will be the last for this season, but guess what? It will also be the most important one. And the reason is we will go over charts, we will go over positions, long and short, that I have within these names, and we will also discuss the implications of these earnings on the broader economy, because we're seeing unbelievable reactions from these earnings. Stocks are down double digits, big time. Certain stocks are down 70, 80, 90% from the top. So what's going on here? Again, this video will be critically important for those who are serious about investing and trading in the long run. So if you choose to pass and not watch, it's your loss. Because I got a good one for you today, and let's dive right into it. Here it is. Last week, we got a lot of earnings from different sectors of the market. In this show, we're going to do Mosaic, FMC, Clorox, CTRA, Expedia, Pfizer, AMD, Airbnb, Starbucks, LYFT, Moderna, Yum Brand, Etsy, Westrock, Meccasin, Shopify, DoorDash, Wheaton, Square, and Zillow. So once again, buckle up your seatbelts, and here it is. Let's start with Mosaic, a name that a lot of you own your portfolios because I've been a cheerleader for this name for a long time. So let's see how these results look like. Here's the problem. Just like we saw with Alcoa and UPS and many other companies that reported earnings this season, the volumes are down, and this could be a bad or a good indicator for different companies. It could be a bad indicator if the demand is down. So there was a lot of speculations in the case of Alcoa that the volumes were down because the demand is down, yet the company managed to eke excellent earnings, and the reason is due to the pricing power stemming from inflation and the rise in aluminum prices. But it could be good, meaning the volumes were down because the company could not fulfill the demand due to shortages or otherwise. In this case, for Mosaic, the problem is the volumes are down. As you can see, the sales volume was 1.8 million tons in the first quarter of 2022. Last year, for the same quarter, it was 2 tons. In the previous quarter, it was around 2.1 tons. So the volumes are down. Is it due to the good reason? The demand is so high they cannot fulfill because of shortages, or is it due to the bad reason, meaning the demand is down? We'll see. But here it is. The fundamentals of agriculture remain intact. The tailwinds remain intact. The prices of corn, soybean, wheat, palm oil, coffee, sugar, everything is moving higher. And therefore farmers are demanding more fertilizer, not less. And here it is. They cannot fulfill the demand. A lot of demand is going to go unfulfilled for now. So the next few quarters, they're going to have unfulfilled demand. That could be a bad sign because the sales are going to go down. But if the pricing power remains intact, the quarters to come will be fine for Mosaic. But it can also be a long-run tailwind because that demand, the assumption is not going to go away. So these are considered back orders, and they have to fulfill that demand sooner or later, meaning they have sales intact in the pipelines. So the answer for now, why did Mosaic volumes went down? The answer is the demand is too high and they cannot fulfill that demand. So this is a good reason, not a bad reason. When we look at the performance of the different segments of Mosaic, here it is, potash, the EBITDA went higher significantly. The headwinds were royalties, rail logistics, and the currency impact, of course. We're seeing this with pretty much every single company. But the sales price, the increase the prices in potash is what made the EBITDA surge significantly higher for the company. Likewise, when we talk about phosphate, it's a similar story. When we talk about rail logistics, the volume, material costs, FX, the currency impact, all of them were negative headwinds, but the commodity price itself, phosphate, went significantly higher. So Mosaic has the pricing power, and indeed it exercised the power. And as you can see, the EBITDA is significantly higher year over year. So with that background in mind, look at the company's income statement. The net revenues year over year were higher by 70.75%. Insane growth. The caveat, though, is the cost of goods sold also went higher by 33.35% year over year, and expenses all in all went higher by 30.69%. Massive increase. The rate of growth in expenses, costs moving significantly higher, but that's being offset by the increase in the rate of growth of net sales. All in all, the bottom line, net earnings, were up by a stunning 758% year over year. Now, I've been an advocate for this name for a long time. I've been playing it both as a bet for fertilizer prices moving higher, but also the demand for natural gas. As natural gas prices move higher, so will Mosaic. because they can pass that extra cost to the farmers. The demand is still high. Now, let's go back to the last time I talked about the chart of Mosaic, and let's hear what I said, because I covered the daily, the weekly, and the monthly chart, and I outlaid my perspective clearly for this name. Take a listen. Here are some bonus charts, starting with the ticker MOS Mosaic. I tweeted a few days ago that I am anticipating a top in natural gas prices, at least for now, a pause, and that will come hand in hand with a pause in the rally in Mosaic. Therefore, I closed my calls and I bought some puts. The chart so far appears to be topping. We have extremely stretched readings on the momentum indicators, the RSI and the MACD. We have a confirmation for the reversal, and therefore I'm keeping the put options trade, although it closed half today, and I'm letting half ride. This is the house money. Let it ride if we have more downside. But I caution from being too bearish against this name, because when we switch to a weekly chart, as you can see, the RSI is closer to an overbought reading, but it could go higher. On the other hand, the MACD indicator is starting a new positive momentum ride on the weekly. So the likelihood is we will see a pause, a correction, a small one, before the rally resumes for Mosaic and natural gas. Again, this is a fertilizer name. It's not a natural gas name, but we trade fertilizer stocks as proxies for natural gas. Another thing to keep in mind is the monthly chart for the ticker MOS Mosaic. You might remember the massive rally exceeding over 1,000% gains in the great energy rally from 2006 to 2008. And I remember back then I used to joke that there is a lot of money in shit. And I was right, because natural gas prices exploded higher, and therefore by default these fertilizer names also popped higher. Who's to say we're not going to be in another great energy rally to come? We're not through with inflation, we're not through with the supply chain issues, we're not through with the energy crisis, we're not through with the Fed's accommodative policy, and therefore once again, if this winter season the forecast comes out indicating that the season will be colder than expectations, watch out for a massive rally here in these names. And here are the updates. Here's a daily chart. Since buying the put options last year for that particular trade, Mosaic went down by almost 18%. And this is critically important because you see that trend line in yellow? That's really important. And the chart kept holding that trend line over and over and over again. So then came the buying opportunity. When we look at the weekly chart, yes, it went down last year, top all the way down to the trend line by almost 23%. But then came the massive rebound, the buying opportunity once again, and Mosaic went up by 137.5% from that point on. And here is the monthly chart. Again, the trajectory, if Mosaic wants to go higher, it could go higher in an impulsive fashion, all the way above 100. The problem is you have to track the daily chart, because when that gets a little overbought, you see pullbacks. Number one. Number two, you have to track natural gas. You have to track fertilizer prices. That is your leading indicator. If these prices start to go down, then probably this name is already done. The majority of the gains have been already booked. Well, look at the daily chart. Are we seeing right now a formation of a head and shoulder pattern? And if it is, then the critical line becomes 59. If 59 is broken, you probably want to wait for a better entry price, because the stock will have further down to go. Next, we have FMC, another agricultural name that we covered in this program before, when I discussed earlier this year ideas in investing in agriculture, because we're seeing tailwinds developing. Specifically after the invasion of Ukraine, we saw a lot of grain commodities moving significantly higher. The demand for herbicides also moved higher. So let's see how the company did last quarter. When we look at the different regions and the sources of revenue, most of them are positive. When we look at North America, for example, year over year, the revenue was higher by a stunning 30%. Likewise, in Latin America, it was up 31%. And then in Asia, it was up 2%. So we're seeing the weakness in Asia. This is a theme across many earnings, not just this one. Here's the problem for the EMEA, Europe, Middle East, and Africa region. The year over year revenue growth was flat, but absent of the currency impact, it would have been up 11%. So the rise in the US dollar shaved off 11% of the growth in revenues for FMC. And therefore, I continue to say the dollar has to cool down. The rise in the US dollar is eroding earnings across the board, not just for this company. But regardless, when we look at the EBITDA drivers, again, you can see clearly the FX, the currency impact, took the EBITDA down by $16. So was cost, meaning inflation. But all of this was offset by the pricing power that the company has. And the volumes were also higher. So I would see this as better than Mosaic, to be honest with you. When we look at the earnings, yes, we're not seeing the explosive growth as in MOS, but the explosive growth in fertilizers was due to the massive surge in prices and shortages due to the Russia-Ukraine war and the sanctions and all of that. But this company is steady Eddie, so we're not seeing a tailwind that caused a massive spike higher and then we could see a cool down of that. This one is steady Eddie. The prices of herbicides have been moving higher in a steady fashion, not an impulsive fashion. Some investors prefer the steady Eddie approach rather than the impulsive moves up and down. In this case, revenues year over year were higher by 13%, costs and expenses were higher by 8%, so you have the rate of growth in revenues exceeding the rate of growth in costs and expenses. You get the bottom line up 15.5% year over year, not bad at all. Now, the stock went down big after reporting. Here's a weekly chart for FMC. I would view that as a buying opportunity for now, assuming that these earnings and the momentum can continue to go on for a few quarters. But again, the MACD indicator is a little elevated for my taste. And remember, the RSI is a leading indicator. The MACD is a lagging. We use the MACD as a confirmation. So the MACD is going to go down, crossing, producing red impressions in the histogram. And the bullish case for buying the dip here is if we see consolidation, meaning we don't see a spike higher immediately. We see consolidation, holding ground, gathering energy, and then we see all of these overextensions in the technicals being worked out. If the company's fundamentals remain intact, we could see this name moving higher again. So I'm sticking with FMC for now. Next, we have Clorox, CLX. Let's see how these earnings came out to be. The net sales were higher by 1.57% year over year. Here's the problem. The cost of goods sold went higher by 15.19%. On the other hand, expenses went down by 1.6% year over year. So the problem here is you have the rate of growth in costs moving higher and faster than the rate of growth of net sales, meaning Clorox is not exercising their pricing power. Maybe they don't have the pricing power. Maybe if they increase prices higher, they lose the generic brands, and therefore this company is limited and cannot fight inflation for too long, or at least as good as, let's say, Procter & Gamble. And therefore the net earnings, yes, they went higher, positive year over year, but again, not impressive, knowing the fact that the company is not enjoying the pricing power that other consumer staples are. But perhaps Clorox has the pricing power within certain segments of the business, not all of them. When we look at health and wellness, for example, net sales were down by 3% year over year, yet the income, the earnings for that particular segment was higher by 146% year over year. So they're selling less, but they're jacking prices higher, and therefore the earnings came out positive for this particular segment. When we talk about household, sales were higher by 6%, but earnings were down by 5%. Likewise, for lifestyle, sales were higher by 4% year over year, yet earnings were down 3% year over year. International sales are up 1%, and earnings were also up 3% year over year. All in all, for the company, the growth of sales 2% year over year, barely, yet the earnings increase year over year was 439%. And this is because it was pinned to negative earnings last year. Now, do you choose this name or let's say Kimberly-Clark, for example, or Kellogg's or Procter & Gamble? I say at this stage you want to stick with the consumer staples, specifically food producers. That could be Kellogg's, could be General Mills, it could be Kraft Heinz, could be Mondelez, could be Hershey's, because the household brands are going to weaken over time. Now, what about the technicals for Clorox? Here's the last time I covered the chart, and I intended in buying the stock via call options, but it did not work out. Take a listen. Now, this chart doesn't look toppy. If anything, it looks like an opportunity to buy, because we have a descending sloping line of resistance. This is a weekly chart, by the way. The chart broke above that line, and we confirmed it as support. What does that mean? I bought call options with the intention of owning the stock if it happens next year. You see the momentum indicators, the RSI, the MACD, all moving higher, gaining steam. The bottom line is, you gotta be picky. You gotta be surgical and tactical in your picks. Don't be lazy and buy ETFs. There are gonna be winners and losers. Buy the winners, avoid the losers. Easier said than done, but you gotta use the technicals as a guide here. And here it is. Since that call, Clorox went higher by almost 10%, and then it flushed down and it lost all of these support levels entirely. So again, do we want to buy Clorox at this stage? Not really. Stick with food producers in consumer staples. Avoid the household brands. Next, we have CTRA. A lot of you own this name because we talked about it in this channel before when I covered the momentum trades for natural gas. Take a listen. Here's another one. The ticker CTRA. CTRA, this is a monthly chart, and as you can see, we have support, solid support, at around, let's say, 15. The chart, if it wanted to break below that number, could have done that long time ago, but this level held on over and over and over and over again. We also have a sloping line of resistance, and recently, this month, the chart managed to break above that sloping line of resistance. This is a bullish breakout. You look at the momentum indicators, they're not even that extended as we've seen with other charts. So I really, really like this chart, and I've been liking it for a long time, by the way. And here is the debt to assets ratio. Look at that, 0.17. You cannot get any cleaner than this. This company is coming back in a big way. Now you factor in the fundamental tailwind of substituting Russian natural gas to European countries, and this stock could go much, much higher. And since the crossing of the sloping line of resistance, now support, the stock exploded higher and gained almost 50%. Yep, 50%. So when folks talk about the stock market crashing, there are no opportunities, yada, 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 here it is. About 50% gains in like what, 3 months now? Not bad at all. But here it is. Let's take a look at earnings and see if the momentum can last or not in this name. And here it is. As you can see, the company is developing more wells. They're producing more. The lateral length is increasing. They're also managing costs impressively. The efficiency is critical for this company, and they're managing efficiency in a really impressive fashion. What not to like in this company? The revenues, all in all, went higher by 365% year over year. Expenses went higher by 309% year over year. All in all, the bottom line came out at 482.5% increase year over year. And of course, the viewers asking about CTRA, the stock was up over 9% after earnings. Do you book profits or not? That's up to you. Of course, we're all waiting for the dividend, but you don't want to wait for the dividend and then you lose 20% waiting if we have a crash in the stock market. And therefore, I say you got to use option strategies. In this kind of environment, in this stock market, if your stock goes up big, you want to sell upside calls, and that will enable you to raise some cash. And if the stock blasts higher, you have the option to sell some stock or to cash in the call options. Another strategy would be selling put options if your stock goes down, yet you continue to believe in the company because it is a winner year to date. So you sell these puts, and then you're going to have the choice, the option to exercise them and perhaps lower your entry price by adding more shares at a lower price. Another strategy would be flat out buying puts. You buy these puts as protection, and that way you can sleep like a baby at night, because not a lot of us have the luxury of selling stocks right away due to taxation reasons or dividend reasons in this case. So again, factor in all of these and make your decisions accordingly. But it is critically important to use option strategies in this stage of the stock market. Next, we have Expedia, an important name because it is a pulse for the health of the economy, specifically spending on services, the so-called reopening, which we've been waiting for to happen. Well, when we look at revenues, they went higher by 80.5% year over year. Expenses and costs went higher by 57% year over year. The net loss was reduced by 79% year over year. So far, so good, right? So why did the stock crash? Well, how about 3 reasons? Number 1, look at the expenses, specifically selling and marketing. That was up higher by 102% year over year. So they're spending like a drunken sailor. That's number 1. Number 2, to be fair, you got to pin these numbers with 2019, not 2021, because we want to see whether the reopening is really recovering the company's bottom and top line from 2019 or not, because the stock is certainly trading above 2019 prices. So the earnings have to be a lot better than 2019, right? Wrong. Look at this. Revenues, when we pin the first quarter of 2022 with 2019, same quarter, revenues were down 13.2%, but expenses were also down 13%. All in all, the net earnings were down 18.44% from 2019 levels. This is not good. This is a stock that went way ahead of itself, just like we're seeing with hotels and casinos and the rest of them, based on the so-called reopening optimism. And these stories, these moves in stocks based on hooey, no fundamentals at all. We're seeing these stocks crashing as we speak. So look at the stock market. Look at these stocks. All of these stocks that went higher based on the so-called reopening, and they're still trading high. These are perhaps the only LYFT shorting opportunities in the stock market besides the FANG and the big caps. Now, yours truly right here shorted Expedia back in July 2020. And here's a tweet where I was commenting on announcing adding Mondelez and Freeport-McMoRan to my portfolio back in July 2020. I also added Expedia as a short, and I added Chevron as a long, and I said Expedia short doing well today, Chevron long not so much. And it's ironic because fast forward almost 2 years later, one stock, Chevron, did phenomenally well, and the other one, Expedia, well, not so hot so, because here's the chart, a massive crash this week. What does that say? It says that the story is falling apart. The story of the reopening optimism, Expedia will make more profits and revenues than 2019, not happening, and it will not happen. So this gap, you see that gap, 103.72, that's going to be closed 1,000,000%. And of course, I shorted before the gap, and then when the gap happened, I had to cover because otherwise I would have gotten a margin call. But now, fast forward almost 2 years later, my thesis is proving to be true. These names will never recover 2019 numbers. It is what it is. Next, we have Pfizer. Let's see how this one did. Well, the revenues were up 77% year over year. Impressive. Costs, expenses were up by 47.87% year over year. And again, you have the dynamic where the growth rate in revenues exceeding the growth rate in expenses. And therefore, the bottom line net income was up 61% year over year. Not bad at all. Here's the problem. This company would have been dead, absolutely dead, absent of the jabs and the cheerleaders for Big Pharma, the cheapies and the morons who were cheerleading for the draconian lockdowns, forcing people to get jabs they didn't want to get, and most importantly, perhaps didn't need to get. Regardless, it all goes in the pockets of Pfizer, baby, so keep cheerleading for Big Pharma, you morons. Vaccines revenue was up 305% year over year. Absent of that, this company would have been in the dumps. Next, AMD. Why is AMD important? Number one, it is the growth engine of the stock market. If AMD goes down, then we know growth is over. We should just dump everything and go back to sleep. Who cares about the stock market anymore? Number two, it is a cyclical indicator. Semiconductors, in this case AMD, is a leading indicator for the health of the economy. So let's see how it did. Revenues were up 71% year over year. Stunning. You cannot find this kind of growth except in Mosaic, for example. So it's between shit and semiconductors. Pick your pick. But here's the problem for AMD. The gross margins were down. Yep, down. Quarter over quarter. Yes, up year over year, but down quarter over quarter. So is this the beginning of the slowdown in growth in AMD? Not so fast, because the acquisition of Xilinx cost them a lot. So you're seeing net income is down when we use the GAAP accounting methods, which we should go by with no exceptions at all. So I don't buy any excuses of, oh, we incurred one-time charge or we bought Xilinx or whatever. It doesn't matter to me. At the end of the day, what I see in the sheets is the following. Gross margin is slowing down quarter over quarter. But we have to put things into perspective. Why did it go down? The acquisition of Xilinx. Likewise, the earnings per share went down quarter over quarter, big time, once again due to the acquisition of Xilinx. The revenues year over year, 71%, quarter over quarter, 22%. Operating expenses up by 110% year over year and up by 59% quarter over quarter. So this is the problem with AMD. Do they have the pricing power to keep up with this inflation or not? Because the growth rate in expenses is surging higher and faster than the growth rate in revenues. And therefore, the bottom line, net income, year over year was up by 42%. That being said, quarter over quarter was down 19%, factoring in the acquisition of Xilinx. But the problem here is not the acquisition of Xilinx. The problem here is the growth rate of expenses versus the growth rate in revenue. So is this the beginning of the slowdown in AMD? Perhaps. But again, where else are you going to get a 71% increase in revenues year over year? Where else are you going to get this kind of growth in this stock market? The answer is very few options. Next, let's talk about Airbnb. The revenues year over year were up 70%. Costs, expenses up by 13.5%. So you have the growth rate in revenues exceeding the growth rate in expenses. All in all, the net loss was reduced by 98.4%. I see this report as impressive, folks. Between Expedia, Marriott, and all that trash, and Airbnb, I'd go with Airbnb. The growth remains intact. It is beating companies like DoorDash, for example, when we talk about the recent IPOs. The problem with Airbnb is the overvaluation. So you look at the revenue trend, for example, moving higher. So far, so good. The net loss is being reduced dramatically. They're about to go positive here. The EBITDA went up big for the first time. So again, the company is doing phenomenal. The problem is the stock and the overvaluation. Now, I've been a critic of Airbnb's IPO from the get-go. I've been saying this is insane. This is going to end up badly because it was priced in as $68 a share. But the lunacy, the mania, pushed it all the way to 150. Remember that? And I said, no way. I mean, you cannot push valuations this crazy and expect good results. But regardless, the sheepies, the Robin Hoodiots, and the likes continued to buy Airbnb because the future, bro. Who cares about valuations? Valuations don't matter at all. Well, apparently they do, because fast forward since the IPO, about over 500 days later, we're back where we started. Pretty much exactly. The stock is actually down about 2% since the IPO, and in all likelihood, it's going to keep going down because the economy will slow down, spending on travel and leisure will go down, and we will see Airbnb results also going down. But it's all due to the overvaluations. The company was doing just fine. If the stock was trading at $60, I would have bought with both hands. Next, we have Starbucks, and let's see how these results look like because the stock is down big. Revenues were up by 14.5% year over year. Expenses were up by 17% year over year. The product cost was up by 23.8% year over year. So that's a problem when you have the growth rate of costs and expenses exceeding the growth rate in revenues. But for now, net earnings were higher by 2.3% year over year. When we look at North America segment, revenues were higher by 17% year over year. International, on the other hand, was up by only 4% year over year. So the majority of the slowdown is coming from the international sector, specifically China, and of course, getting out of Russia. That's going to take a bite. So the question is, do you buy the stock now that it's down big? Do you sell? Do you short? Let's look at the technicals, and last time I covered this chart. Take a listen. Next, we have Starbucks, a weekly chart, SBUX. Clear winner year to date, a candidate for profit taking. We have a head and shoulder formation. We have a massive gap down there. In all likelihood, sooner or later, that gap will be filled. This is a name to fade. And here it is. Since then, the stock is down over 33.5%. Now, it is getting way oversold. It lost all of the pandemic gains. It is trading below 2019 numbers. Is it really justified? Perhaps not. And if you want to buy Starbucks right now, just make sure that you know two things. Number one, the stock is not going to go back to all-time highs again. That's going to take a long time, if ever. Number two, if you're going to buy the stock right now, make sure that your investment horizon is 5 years plus. If you're going to buy till the end of the year and we see a crash overall in the equities market, guess what? It doesn't matter if the name is oversold or not. It doesn't matter if the name is undervalued or not. They're going to dump the ETF and sell indiscriminately, and that could hurt Starbucks. Next, we have LYFT, a name that I'm shorting right now. Now, I've been shorting for a while because I've never believed in this reopening bullshit. Never. But here are the results for LYFT, the last quarter, I should say. Revenues up 44% year over year. Costs, expenses up 4.82% year over year. And all in all, the net loss was reduced by 54% year over year. So what's not to like here? Well, the problem is, with gasoline prices moving higher, significantly higher, and we're about to head into a recession, the demand for rides is going to go down, and their expenses will continue to move higher. They have to incentivize all of these drivers to hold their noses at the gas pump because they're getting a decent pay. And this is what I said last time I covered LYFT's chart. Take a listen. Why are we talking about LYFT? The reopening stocks were catching a bid, but perhaps the best is behind us now. Doesn't mean that they're not going to go higher. But this name in particular is becoming extremely weak. From a technical perspective, we have the head and shoulder formation. We have a failure to break in the MACD indicator, curling down to create more red impressions in the histogram. This is yet another signal for massive weakness in the stock. You combine this with the fundamentals. The company is running out of drivers. There is a massive shortage of drivers. Why? Who knows? You have the $300 a week. You have everybody winning in this casino. You download Robinhood, you buy call options. Who needs to drive for LYFT anymore? Add to that high gasoline prices, the wear and tear on your vehicle, the assholes you have to pick up. Who needs that? Who needs that? Specifically when we have a casino where nobody loses. Quit your job and join the casino. Easy money every day. Meaning that LYFT will have to hike their wages, their benefits, their bonuses, their incentives, and that will kill the margins of LYFT, whatever left of these margins, let alone if we actually get lockdowns once again due to Delta being worse than expected. And here it is, the update. LYFT is down big since then by almost 64%. Is it overdone? Perhaps. But again, the sentiment soured across the stock market. So do you cover your short right now? Do you wait? Well, the technicals say you should cover. The fundamentals say we have a long way to go. This company could be in a world of pain, let's say in the fourth quarter of this year, as we see the recession playing out. Next, we have Moderna. And look at that, they give you the booster thing. If you get the jab for the other jab, for the next jab, for the one after that, your immunity gets a little bump higher, specifically when you face the Pokemon variant. I wish they could provide a chart for the risk of heartburn, because that would be interesting. But here are the results for Moderna. Revenues were up by 213% year over year. Expenses were up by 174% year over year. Again, revenues moving faster and higher than expenses. The bottom line came out pristine at 200% increase year over year. Once again, thank you to Fauci and the propagandists and the cheerleaders, the sheepies on Twitter and the likes, forcing everybody to get the jab. Well, here it is. Moderna is doing just great. The company, of course. The stock, that's a different story. And somebody shorted exactly at the top. Yep, the guy you're listening to right now. What about the ticker MRNA, Moderna? We have a bear flag, and the CEO of Moderna says we will go back to normal next year. In other words, please short my stock. We're done here. I made hundreds of millions of dollars, perhaps billions. We've been dumping and dumping and dumping. Please short our stock. We're done here. And therefore, my call is Moderna will flush down all the way to close the gap, as you can see right there. It's going to close the gap and perhaps fall all the way down to the trading channel. This will be one of the biggest corrections that you have ever seen. And I'm going to tell you this one feels good. Every time I short a stock and it crashes, I feel kind of guilty because what about the holders and yada, yada, yada. But this one gives you satisfaction when you look at this chart because it went down since that time by over 69%. And I covered some of my shorts last year, but I still have a portion of the shorts continuing to go on. And my expectations are if the jab revenue stabilizes, without the jab revenue, the company can go back to, let's say, annual revenues of 2 to 3 billion. Now you have a company being priced at over $50 billion. If that is the case, we got a long way to go to the downside here. But of course, remember the tailwinds that the lunatics were buying this stock based upon? You don't understand, bro. The jabs, not just the jabs. The company's gonna cure cancer. It's gonna cure AIDS. It's gonna cure baldness. It's gonna cure stupidity. Well, at least not for now, and therefore the stock is down big. You see, I got all of these legendary shorts, yet nobody made a movie about me. They made a movie about the Big Short. He just had one short. You know why? Because I'm not seeking any attention.
Underestimated from day one. You'd never think I was a master of the universe now, would you?
And of course, the fact that nobody gives a shit about me anyways. Anyhow, let's move on to the next one. Here it is. EXPE, another name that I'm shorting right now. Let's see how it did. The active buyers went higher by 7 million new accounts, so the growth is still intact in the company, no problem here. And of course, they have to do the woke thing when they say our core buyers identify as women, right? What about if I'm gender fluid? That'll mess up your statistics, right? But anyhow, here it is. Revenues were higher by 5.19% year over year. The cost of revenue was up by 21% year over year. Expenses were higher by 25.22% year over year. So again, you're seeing the pace of growth, in this case revenues, slowing down. The consumer is shifting their behavior from online spending to spending on what? Rents, utilities, gas, groceries. They have to. We are at the ugly stages of inflation right now. On the other hand, speaking of inflation, inflation is destroying corporate margins. Even if they continue to increase prices, folks, these increases in operating expenses and the cost of revenue, you cannot fight that for too long. At some point, it's going to eat you away. At some point, inflation is going to crush the bottom line of corporate America. As you're seeing right now in EXPE stock, the net income was down 40% year over year. And we will see this replicating in many other companies. Sooner or later, inflation will kill everything, and therefore the Fed must act now. Where is the Fed, you might ask? Well, the Fed remains in a coma. And of course, I've been a critic of EXPE. I've been saying the stock should not be rallying back in November of last year. And I shorted the name. And guess what? Right around that time, EXPE marked the top. And it went down from that point, not looking back at all. What does that mean? We're seeing the top right now in the fundamentals in the first quarter of this year. Yet the stock of EXPE topped in November of last year, meaning the stock predicted all of this since last year. Take a listen. The majority of the juice in this stock is already squeezed. You can squeeze a little more, but you're stretching it at this point. And therefore, I believe that this stock is not going to maintain the rally and the pop after earnings. Matter of fact, it will go down to revisit the trend line, and this will be top to bottom, a correction of about 23%. So the chart moved a little higher since then, and then it pulled down, losing over 30% top to bottom, if this is indeed the bottom, all the way to the trend line. The test for now is, can EXPE hold that support? My hunch is it will not, because it is a winner year to date. It is a candidate for profit taking. Watch out, the moment that support line, that trend line is broken, you will see a lot of selling that will follow. And here it is. Since then, EXPE is down over 62% since breaking the trend line of support. These are massive crashes, folks. And when stocks go down like this, they're predicting that earnings will go down. So when you have geniuses on TV saying, oh, the stock is down big, but the last earnings report is good. So there is a disconnect here. Perhaps it is a buying opportunity. No, the stock is predicting what's about to come in the fundamentals, because the stock market is always a forward-looking mechanism. It sees what's about to happen ahead of time and it acts accordingly. So do I cover EXPE right now? Do you buy the dip in EXPE? You can't say that for sure, because the name remains overvalued. And in this market, there is no mercy at all for anything that is overvalued. Who's to say the stock is not going to go down in a retest of the 2020 lows? That could happen. Until and unless I see a sign that the stock is reversing higher, I'm not interested or incentivized to cover at all. Next, we have Yum Brands. Why is this important? It is important because it is a pulse on China. Now, when we look at KFC, and damn it, every time we do these earnings, I get hungry. But anyways, the system sales, look at that. What does that mean, system sales? It means the sales all in all for the company-operated restaurants, but also for the franchises. All in all, the system sales went higher by 6%, and absent of the rise in the US dollar, system sales internationally went higher by 11%, but again, the rise in the dollar ate that away. KFC is doing pretty good in India, for example. Sales went higher by 41%. Thailand, sales went higher by 21%, Africa 25%, Middle East, North Africa 40%, Latin America 34%, in Europe 37%. So the growth internationally, so far so good. With the exception of China, China is down 4% for understandable reasons. And then you have the good old USA, the growth is barely 1%. So again, we're seeing a slowdown in North America, but impressive growth in KFC, in India, Middle East, Africa, Latin America, even in Europe. So no problems here. KFC is on fire. Taco Bell, maybe it's not on fire, but it will certainly make your anus on fire. Anyhow, here it is. Taco Bell, the system sales went higher by 8% year over year. Pizza Hut, the system sales went higher by 2% all in all, and absent of the rise in the US dollar, growth would have been 10% in international markets, but again, in the US, it is down 6%. And again, Pizza Hut is the weakest link in Yum Brands when we talk about North America. United States. Sales are down 6% year over year, and China down 1% year over year. But again, you look at Latin America, 18%, Europe, 28%, Middle East, Africa, 16%, in India, stunning 44%. So these brands are doing phenomenal in overseas market, not here. All in all, the revenues for the company went higher by 4%. Why? Because they don't capture the entirety of the system revenues. They get a cut from the franchise, and therefore revenues went higher by 4%. That's it. Costs, expenses, they went higher by 10%. All in all, the net income was up by 22%, but don't get deceived here. It only went higher because last year they had to pay taxes, the provision for taxes. This time around, they were actually receiving credit. So that's the only reason why net income was higher by 22% year over year. Matter of fact, when we look at the chart of Yum Brands, this is a weekly chart, we had had a steep trend line, a bullish trend line. That has been broken right now, and it is just a matter of time before we see a flush down in this name. So this one is a faded, shorted, not going to do good from this point on. Next, we have WestRock. What do we see here in this company? An important indicator, by the way, for the health of the global economy. What's more important than paper? But look at this. When we look at the EBITDA, inflation was a headwind big time, shaving off, about $495 million from WestRock's earnings. Likewise, the currency impact, once again, shaving off $35 million, but the volume was up and the pricing power was exercised, contributing about $718 million to the EBITDA. Net sales were higher by 21.27% year over year, but so was the cost of goods sold by about 18.7%. Expenses were higher by 7.6%. All in all, the net income was down a stunning 64.44%. Now, the chart is good. I mean, it has been going down for a while, so perhaps it is bottoming right now, but I own the sister company, International Paper, the ticker IP. I've been a shareholder since 2020. Let's see if this name, International Paper, did a lot better than WestRock. Well, net sales were higher by 14% year over year. Expenses were higher by 14.5% year over year. All in all, the net earnings were positive by 3.15% year over year. So it is a close call, but International Paper pays almost double the dividend from WestRock. And when we look at the chart, the weekly chart for IP, International Paper, are we seeing a formation of a reverse head and shoulder? If that is the case, we will see higher highs in IP. So I'm sticking with the name for now. Next, we have Mckesson, the ticker MCK, and this is an old school medical company that goes out for almost 100 years, and this name was included in the Biden portfolio, which I shared with you in this channel right after Joe Biden became president. And of course, when it comes to Joey B, you cannot really have a portfolio. The right portfolio for the Biden portfolio should be shorting everything, because as Obama said, don't underestimate Joey B's abilities to F things up. But regardless, the majority of these names did pretty good. Specifically, this name, Mckesson. It was, at some point, the most undervalued stock in the stock market entirely. Not anymore. But here are the results for the name. The revenues were up by 12% year over year. Cost of sales up by also 12% year over year. Expenses are up by 17% year over year. All in all, the bottom line net income was down by 43% year over year. Why? Well, because they had one charge, litigation charge, due to the opioid settlement. They paid big bucks. But even if you add that up, the net income is still down year over year by over 30%. So is this the end of the run in MCK? I bought it back in September of 2020. Could it be the end? Well, here it is. Since then, the name is up over 127.5%. Here's the problem. This is a weekly chart, by the way. Yes, it is begging for a pullback. But the psychology is important. The shareholders are waiting for dividend day, which is around the 31st of May, by the end of the month. I'd love to wait and hope that the stock is not going to crash before then, because I'd love to capture the dividend and then dump the name, because obviously it is becoming overbought, technically speaking. It is becoming overvalued, fundamentally speaking. And as you've seen, the net income growth is now negative. You don't want to be in this stock, so perhaps it's going to be a shorting opportunity, but I'm waiting till dividend day and keeping my fingers crossed that it's not going to crash until then. Next, we have Shopify, and again, when Shopify came out with the stock split, it was a desperate attempt to pump the stock higher. It was abundantly clear that this company is in a lot of trouble. Otherwise, they wouldn't try to pump this stock right now via stock split. That is so 2020. You cannot use the stock split to pump stocks right now. Guess why? Because the majority of the Robinhood idiots, well, they're now extinct species. They're holding a lot of bags. They don't exist anymore. And here it is, year over year, the revenues were up by 21.7%. The cost of revenues was up by 31.64%. Operating expenses were up by a stunning 67.25%. Again, you have a dynamic where costs and expenses are rising faster and higher than the growth rate of revenues, and therefore the net income, this is a massive bomb, by the way, a nuclear bomb. Because on top of that, they're also doing M&A, these geniuses. Can you wait for the stock market to crash and then you scoop up these companies for pennies in the dollar? Why buy now? Anyhow, the net income went from a positive $1.2 billion last year to a loss of almost $1.5 billion. And of course, the stock topped last year, predicting that this will happen. Take a listen. Then we have the ticker SHOP for Shopify. It had a massive divergence from the trend line, And now it is correcting that divergence by revisiting the trend line. We have yet another 7 or 6% more before we get to the trend line. This is a weekly chart, of course. If that line is broken, then you will see a lot more selling in this name. This is yet again a candidate to fade. It's a winner for the year. It's a high multiple name. It's not the kind of name you want to be in when the Fed is tightening. And therefore, yet again, this is a faded kind of chart. And here it is. Since then, since the break of the trend line, the stock went down by over 70.5%. Unbelievable. And if that wasn't enough, since the top, the stock of Shopify is down almost 80%. What does that say about the pace of growth in this economy? It's dead, and Shopify is sending an ominous sign to this economy. TikTok. And no, we're not talking about the stupid app. We're talking about TikTok as watch out here. And of course, this is the alarming trend we've been talking about in this channel for a while now. When inflation continues to move higher, the priorities of the consumer shifts. And instead of spending on goods and shopping online, for example, they're going to shift that spending into the gas pump, the grocery store, utility bills, rents, and they're not going to have enough to spend on the economy. In this case, Shopify says, oh, the consumer is spending to services right now. Some of that is true. For now, the consumer is traveling, they're going out to eat at restaurants, they're booking trips, and yada, yada, yada. But as the economy sours, they're going to be forced to spend on inflation, meaning the essentials, and let go of the non-essentials. And then we see the entirety of the economy, goods and services, falling apart. So if anything, these results and the confirmation from Shopify is an ominous sign for the future of this economy. Next, we have DoorDash, another name that I'm shorting, and I went in and out with this name because it had phases and cycles. For now, for the quarter that was, revenues were up by 35.19%. Most of that came from my pocket, by the way. But here it is, costs. Expenses were higher by 38.5% year over year. And again, this is a bad dynamic when you have the growth rate in costs and expenses moving higher than the growth rate in revenues, and therefore the bottom line was a loss. And these losses increased by 51.8% year over year. So look at two growth companies, Airbnb and DoorDash. Both IPO'd pretty much at the same time. One, Airbnb, the growth remains intact. The other one, DoorDash, the growth is falling apart. We thought at some point DoorDash is going to provide positive net income. Not anymore. Airbnb maybe, but will the next quarter be the peak in Airbnb because the economy will be in a recession after that? This is the problem with Airbnb. But again, here it is. I was a critic of DoorDash from the get-go. The valuations did not make sense at all, and the signal, the short back then, was during the infamous crash of 20% in a single day, perhaps the biggest shooting star in history. And since then, the stock went down by 42.5% almost, and then it rebounded higher by over 132%. But it gave you another chance to short at the double top at around 256, and since then, the stock is down in the dumps, losing over 75%. Again, we see these crashes, 75%, 85%. What do you think will happen in this economy? And I know the stock market is not the economy, but it is. You see, the stock market doesn't track the economy, but the economy tracks the stock market, meaning if the stock market crashes, we all face the consequences. If the stock market surges higher, only those involved, meaning the rich, the 1%, because those are the majority, those are the ones who reap all the benefits. Once again, thank you to the financial engineering from the Federal Reserve. Next, I have Wheaton British Precious Metals, a stock that I own in my portfolio, but the earnings report was not that good, to be honest with you. The production was down all in all, year over year, and it was down when we talk about sales. So things are slowing down here. What about the pricing power? Well, that varies because they produce gold, silver, cobalt, palladium. As you can see, the units produced, that was down across the board, year over year. For silver, for palladium, for cobalt, gold was barely higher. So they're producing less, a lot less. However, what they're selling, the units sold, gold was higher by 3.7% year over year. Silver and palladium, these are the two areas of concern for this stock because they sold less palladium and silver year over year. But cobalt, the sales went higher by almost 287% year over year. What does that mean, all in all? Here it is. When we look at the realized price of gold, for example, it has been moving higher, at least in the first quarter of this year. And therefore, maybe they sold less quarter over quarter, but all in all, the gold segment was positive. When we look at silver, the price went down year over year, and they're selling less. So a bad dynamic all in all. Price is going down, and they're selling less. No wonder why silver revenue was down. When we talk about palladium, the prices went higher due to the Russia-Ukraine war, but they sold less. It didn't matter because of the increase in the realized price. The palladium segment was positive, but that's not going to last because since then, palladium prices went down. Cobalt is the growth engine of this company. They sold more quarter over quarter, year over year, and the prices of cobalt continue to move higher and higher and higher, and therefore it is the best performing segment in this company. All in all, the net sales were down 5.2% year over year, yet the cost of sales went down by 14.4% year over year. Expenses went down by 3.41% year over year. All in all, the net earnings down by about 2.8%. Again, is it a big deal for now? Well, you got to look at gold and silver prices. If these don't improve, let's say by the end of this month, then you probably want to abandon Wheaton and any gold miner for that matter. When we talk about the technicals, this is the last time I talked about WPM. Take a listen. Here's my favorite one because it is more diversified. It's not just gold. They have lithium and other metals. Wheaton precious metals. I bought the stock before and I sold it. You see that circle, the highlight? That was a topic formation. We talked about it in the program before. I dumped right there and then. But I'm starting to like this chart again because what if we're seeing right now is a formation of a cup and handle which will move this chart above 47, the prior resistance. These are just ideas, folks. Study them, do your homework, and make up your own conclusions. And here it is. Since then, the stock went higher by over 27%, but since then it went down again. So this is the debate period for now. If gold continues to go down and it doesn't pop higher again along with silver, this is going to be a problem for WPM. So watch these prices carefully and make your decisions accordingly. Next, we have Square, aka Block, and things went downhill the moment Jack Dorsey, the CEO, decided to take a break and go to India and seek spiritual guidance, hiding in a cave while learning the Bhagavad Gita or the Kama Sutra, whatever the hell he was doing over there. But he came out with a revelation, and this revelation is go all in tulips, Bitcoin, all in. And since then, Twitter is down, Square is down, everything is down in Dorsey's world. Year over year, the revenues for Square down 21.68% year over year. The cost of revenue is down 34.8% year over year. And the operating expenses are up 70% year over year. All in all, the company lost over $200 million last quarter alone. Thank you to the Bitcoin lunacy. Now, I've been shorting the name for a long time now. I've been a critic of the fact that we have Square and PayPal worth more than Bank of America and Goldman Sachs. And back then I said this is irrational. What are you, crazy? And now we know. Yep, there is no such thing as valuations don't matter. They do. Both PayPal and Square are in the dumps. And this is back when I shorted Square. Take a listen. And here are two bonus charts for the day, starting with Square. I issued a tweet today saying that Square looks like one of the weakest charts in the market right now. What do I mean by that? We had a clear, defined trend line. We had a series of higher highs and higher lows, and that is broken now. We made a lower low, and we made a lower high. We also broke in the support of the trend line, and it's starting to look very, very bad here for Square. Furthermore, here is the weekly chart. What do you see here in the weekly chart? A bear flag formation, breaking the trend, and the momentum indicators, the MACD dipping into negative territory, creating red impressions in the histogram. Likewise, the RSI has a lower divergence. All the signals and the indicators pointing out that Square will start to dive lower. And therefore, I bought put options today, and my expectations are that we will go all the way back at least to 197. That would be the support, and then we'll take it from there. And here it is. Since then, the stock formed a saucer topping formation, and since then it crashed big time. Matter of fact, since the top, it is down. It went down by over 71%. Unbelievable. Well, perhaps it is, because when you drive stocks to these insane valuations based on nothing, based on optimism, well, reality is going to hit at some point, and the pain of bag holders is the joy of bears. It's the way it is. Lastly, let's talk about Zillow. This is another disaster, by the way, and spells doom for the economy, just like Shopify, just like Etsy, just like the rest of them, DoorDash. Alarming signs across the board. Here are the results for Zillow. The revenue year over year up by 349.5%, but the cost of revenue is up by 509.4%. The operating expenses up by 38% year over year, and the net income went down by 69% almost year over year. This is trash. The company's probably going to go down to zero, and therefore I continue to hold on to my short. I shorted last year, and I'm still holding, even though the stock got hit again. Everybody said, oh, this is the bottom. Even Mama Kathy bought the dip in Zillow. Not me. Take a listen. Next, we have Zillow, an epic disaster, and perhaps a significant warning regarding the health of the housing market and the economy, by the way. This happens to be a name in my short portfolio, and it is the best performing name in that portfolio. I did not know that their home flipping business is a bust, but the thesis for shorting the stock was technical in nature, and we have rates rising higher. This is not good for a company like Zillow. I was intending to cover today before earnings, yet the stock was already down 10% before earnings. This is usually, not always, but usually, a warning signal that there is a massive bomb in the report, and the news was leaking already ahead of time. For example, before the stock even reported earnings, it was trading down by over 10%. And the reason is we got the news that about 2/3 of the homes that Zillow bought in their flipping business, they're already underwater, meaning they're losing money. The geniuses that they are. And here it is, the weekly chart of Zillow. Now, I shorted after I saw the spike top pattern, which is a 100% guaranteed shorting opportunity when you see a spike top in any chart, specifically this insane, in a weekly chart. And spike tops on daily and weekly charts, oh, they stick for years to come. But even if you did not short since then, even if you waited for the crash in the last earnings report when the stock went down big and everybody said it is a buying opportunity, perhaps you got to cover your shorts, Mama Kathy's buying, yada, yada, yada. Well, since then, Zillow is down over 47%. So even if you missed the spike top, you could have gotten it after the crash, and you still made over 47%. And all in all, since the top, Zillow is down over 83%. Unbelievable. But here's the bottom line, folks. When we look at these earnings, stocks down 70, 80, sometimes 90% from the top. Again, what does that say about the future of this market? What does that say about the future of this economy? I see ominous signs. For those who said, oh, this is an overreaction of these stocks, now you're proven wrong because we're seeing the earnings. We're seeing why these stocks crashed last year, why these stocks topped last year, because these stocks were predicting that earnings are going to slow down, and since then, they went down even further. Well, if earnings of companies go down, what will support this economy? Certainly something to think about. And with that, folks, I'm done here with this video. I hope that you liked it, and if you did, don't hesitate to press the like button, subscribe, share, you know the deal. Once again, thank you for listening. Thank you for watching. I will talk to you again soon.
Now, you had what it took to get in my office. The real question is whether you got what it takes to stay.